Good afternoon. I'm David Reese, Chair of the New York City Rent Guidelines Board, and I'd like to welcome you to this virtual meeting of the board. This is the second half of the fourth meeting in a series of public meetings and hearings to determine lease adjustments for rent-stabilized housing units in New York City, with leases commencing or being renewed on or after October 1st, 2022, and on or before September 30th, 2023. We heard from owner representatives in our morning session, and we are now beginning our afternoon session where we will be hearing from tenant representatives. Our first speaker will be Tim Collins of Collins, Dopkin and Miller LLP. Tim, welcome back.
Thank you, Mr. Chair, and thank you for hearing my testimony once again. And I should say again at the outset that as I have every year, the staff has done an outstanding job. And also, I'd like to compliment the chair, and not so much in terms of the outcome of the rent guidelines, some of which I've disagreed with, but I think your leadership has been very steady and unflappable in the face of some rather challenging times. And I certainly have noticed that. I've been watching this process now for, I think it's over 30 years. Yeah, it's actually over 30 years, well over 30 years, close to 35. And the board has really never been better informed. And frankly, I've seen some very probing questions and some real detailed concerns being brought to bear earlier with the earlier testimony and what I've seen in the last few years, and I certainly respect that. One of the things I'm most concerned about is watching people get lost in the weeds, and I'm not suggesting that the board does this, but I think that sometimes the public can get lost in terms of what is right and what is wrong, which direction we should go in, and which we should, what we should avoid. Clearly, we've had an anomalous situation with the pandemic, and that's had a dramatic effects on the real estate market, on rents in unregulated units, on rent collections in all units, and that this anomaly has affected the data to some degree. Unfortunately, there's no provision in the law. You can't go to, rent stabilization code section, 573 and say, this is what you do in the case of a pandemic. So you have to use common sense. You have to avoid arbitrary and capricious judgment. You want to anticipate the future to some degree, and not necessarily ignore what's going on, but at the same time, consider the long-term trends. And that's what my testimony has always been about. And what you have with my testimony, I think you've all received a copy of it, is really just a kind of a baseline set of considerations as to where the rents should go. I've always taken the position that it is not the function of the board, I don't think the law prescribes it, to ensure that every building is profitable or that every housing unit is affordable. I think that there are a lot of considerations that can be brought to bear on the process, but the primary prescribed consideration, in addition to some of the bigger economic trends, is to maintain a steady kind of income base for owners so that they can maintain their buildings. And there are times when you would depart from that. I wish I could be in front of you today saying that, the economy is great, unemployment's down to 2%. Employees at Walmart and Amazon are making $40 an hour, and incomes are up all around, and go ahead and raise the rents. It's not going to hurt anybody. We're not going to have the kind of homeless numbers that we're still continuing to see, or the massive eviction cases that are on the immediate horizon. I can't say that, and others who will testify following my testimony will show that that's clearly not the case, that the tenants are still having a rough time of it. And that kind of raises the concern of, or puts pressure on the board to make sure that it gets things right and that it's not overcompensating owners. And the reality is that by the best evidence that we have, owners are still overcompensated. Owners still have better net operating incomes than they've had historically. And I want to go into that data to some degree and talk about, how you can look at different data points to make a judgment as to whether or not owners are better off or worse off. If you take a simple view of what's happened in 1 year, especially in a pandemic economy, you would end up with a very, I think, myopic result. I don't have any fundamental disagreement with the commensurate rent formulas that the board applies, but they're not recommendations. And frankly, I find it disturbing that some news accounts suggested that the staff of the Rent Guidelines Board has recommended large rent increases. The staff has never recommended any increase. The staff provides data and it provides projections and information by which the board itself has to make these difficult decisions. But the critical thing is the board has rarely operated within a 1 year period and just frozen out what's happened in the past or refused to consider what's on the horizon. The board has to look at the overall health of the real estate industry and the condition of tenants. And as I've testified in the past, whether or not you think tenant income and affordability is relevant, it is certainly relevant if the primary focus of the board, and I believe this is what the law basically prescribes, is to establish rents that would exist in a normal market. And in a normal market, when tenant incomes are down, unemployment is high, and we know it still is high, even though there's been an uptick in some income, still by historical levels, tenants, especially those occupying rent stabilized housing, have relatively limited incomes. And under the circumstances that we see today, there would be a stabilization of rents, even in a normal market. And in some cases, rents would fall as tenant incomes fall. It's an economic factor. It's not just a welfare factor. It's one you could look at in very sort of sterile analytical terms, and you would still come out with a decision which would reflect the fact that the real market is saying that rents should not be going up very significantly, because in a normal market they wouldn't. And again, I think your role is to simulate a normal market. So let's look at what has happened to net operating incomes over various intervals. As is noted in my submission, at the outset of rent stabilization, the rent stabilized stock had, and this is a conservative estimate, an operating cost to rent ratio of about 62.62. That is about 38 cents of every rent dollar went to net operating income, and about 62 cents went to pay for operating costs. That figure by the staff's own recent income and expense analysis is now down to just over 60.2%. Meaning that net operating income over the life of rent stabilization for these buildings has risen to some 39.8%. And this has happened, and this points to one of the areas where I think further research really is needed, at a time when the housing stock has aged on average. I don't have precise figures on the average age of the housing stock at the outset of rent stabilization and the average age today. But I believe that once you get those numbers and some, glimpses of what's happened based upon the HVS, is that on average, the housing stock is older, and one would expect O&M to rent ratios to rise slightly as the housing stock ages over time. So I have said in the past, I think an O&M to rent ratio in the 65 or 66% area would be fine and not troubling at all. And owners would be doing well in very conventional economic terms. And again, we're now down to 60.2%. I should say that there's a caveat here, and I have to be honest about my data, and that is the 1969-70 point of reference of 0.62 versus the 0.60 or I would say the 62% 1969 versus the basically 60% as of the staff's last calculation is not purely an apples to apples comparison. And that is because we don't have a full comprehensive access to income and expenses for those buildings that are less than 11 units. And I think that, to be honest, we have to recognize that and recognize that things might be a little bit different if we did have that full access. But again, the 62% figure from 1969-70 is a conservative figure. taking the lowest number we could have taken. It could have been somewhat higher. So I think that over time, the best evidence indicates that owners have done well. If you take a look at the more near term, and by that I'm talking about the last 30, 31 years from 1990 to the present, when we have very robust data from the City Department of Finance income and expense numbers, it is clear that owners have done very well. And the staff has said that net operating income has risen 46.6% after adjusting for inflation. Owners have done well. There's no way around that. And those numbers are robust, notwithstanding the absence of the smaller buildings, because if you look at a trend line, longitudinal analysis over time, you can't basically assume that smaller buildings are going to have a significantly different trend than those buildings that are captured in the I&E data. So that number, that 46.6%, I think is a pretty reliable number. Now, what is the problem with that? And this has been raised in the past. I don't know if it's come up much with respect to this year's guideline, but people will say, look, there's all these other things that have gone on. There was vacancy deregulation. That was a state policy. There was, MCI increases and individual apartment improvements. Those are state policies that were aimed at, sort of liberalizing things for owners or making buildings more profitable for a time. And that drove up the net operating income. And that's not the business of the Rent Guidelines Board. Well, you can take that position, and that's fine. And I'll accept it for the sake of argument here. I will note, however, that there was a time when it was eminently clear that notwithstanding the data, the Rent Guidelines Board from around 2008 to 2014 basically engaged in a march to the market and ignored the data. And the consequence of that period of gross overcompensation from owners during the heart of a very severe recession is still with us today. So how do we isolate the effects of the state policies and these other policies that may operate independently of what the board is really charged with doing? I have tried to do that over the last several years, and I think in a fairly robust way, although no data is perfect. I have asked the RGB staff to check it because these numbers, I think, are very sensitive and they require being tethered to the data that is produced by the RGB staff. So I want to make sure it's accurate. In one year, it was called to my attention that there was a composite figure that I had missed. And consequently, I've asked them to review and update this. So they've done so. Now, what is it that I'm presenting to the board at this point? I'm asking and trying to answer the question, has the board, through its own guidelines and the vacancy allowances, which were once under the board's jurisdiction and then became statutory later, has that combination of rent guidelines and vacancy allowance has been sufficient to keep up with changes in operating costs? So you'll see that I have what I refer to as the ACA table, which I sent out separately. And it's really comes down to two important numbers, which are the last two numbers in the lower right-hand corner. And that is, I've done an annualized increase, what would be necessary to keep owners whole in terms of covering operating cost changes and protecting net operating income against the effects of inflation. And then I've taken the second column, which basically charts what the Rent Guidelines Board has actually done in terms of what is authorized. It's not what's collected. It's not what is authorized independent of the board increase. It doesn't include major capital improvements or individual apartment improvements. It doesn't include vacancy deregulation or anything like that. The last column is simply what the board has authorized for rent increases. And as you can see, and this is something actually Andrew had pointed out to me a couple of years ago and I didn't pick up on, around 2008, the board was right on the money in that it was about precisely had increased rents sufficient or authorized rent increases that were sufficient to cover changes in operating costs. And then beginning in 2009, you see a radical departure when the board was adopting excessive guidelines. And the effects of those guidelines are with us to this day. So that the bottom line is that in order to keep owners whole, you would have had to increase rents by 181.7%. That's taking that bottom figure and subtracting the 100 base from it. And in fact, the board authorized rent increases on the order of 213.91%. Now, these figures are not absolutely precise, but they're quite good, and it does demonstrate that the Rent Guidelines Board has authorized rent increases significantly in excess of that which would have been needed to keep owners whole. Now, should owners have been compensated at a greater level? Absolutely not. It's clear, and you'll hear testimony through the balance of this afternoon that tenants are still suffering, and they certainly have suffered. Is this the only indicator of owner profitability? Absolutely not. You don't measure profits. You basically don't even control profits. You may have an impact on them in a very indirect way, but profits are based upon what people pay for a building and what the return on their investment is. And you do not control purchase prices. People who go into this market buy buildings, hedging their bets either against the vicissitudes of the market in the case of free market units, or against their anticipation of what regulatory authorities will do. And what regulatory authorities have done, namely the Rent Guidelines Board, is provide a steady and predictable level of increases, which unfortunately has been in excess of what has been necessary to keep owners whole, and has come at a tremendous cost to tenants. I'll also note that, and I haven't done any numbers crunching in terms of a direct correlation, but the number of homeless in the city certainly took a stark increase just about the time that those excessive guidelines were going into effect, and are only starting to come down now. So I do think that there is some connection between certainly between severe rent burdens, but also homelessness and excessive guidelines. Now, I have to say that in the last 4 or 5 years under the new administration, things have come closer back into line, but actually far too slowly in order to correct for the past mistakes. It's really not the job of this board, again, to protect every tenant, but it's not the job of this board to facilitate as I've said, a march to the market, which the board had embarked upon for a period of time. These are very serious decisions that are being made. They affect 1 million households, and they should be made in a way that is close to the statutory mandate and that considers as accurate a base of information as you possibly can get. And on that last point with regard to accuracy of information, I again appeal to the board to consider going back to the Department of Finance to review the audits that were done over 30 years ago now that really should be checked and adjusted. I think that both owners and tenants would welcome a closer review so that the adjustments in the numbers that are made are reliable. And then finally, and perhaps even more importantly, if people want to talk about the health of the real estate industry in New York, if you want to really measure how well owners have done, you have to do so in the context of the full regulatory environment. And the only way to do that is to have comprehensive sales price data over time for rent stabilized buildings, and a way to compare that data with what's happened nationally, perhaps in other urban markets with lots of multifamily homes. And I think, and you'll hear some testimony later with respect to New York, I think you will see that owners have done very well, not only here in terms of the RGB staffs clearly showing that NOI has gone up, not only here in terms of my showing that much of that increase is a result of the RGB's own decisions, but I think you will see that the return on investment by way of appreciated value has been significant. And I just want to add one other thing to that. and it's a bit of a philosophical point, but I think it's very important. The housing market in New York City is not a neutral market. It's not, the status quo is not neutral in the absence of rent stabilization. The housing market is affected by a huge number of things, monetary and fiscal policy at the federal level, local land use regulations, the commitment to green space, the support of public institutions, the maintenance of transportation systems, et cetera, all affect the value of housing in the city. And if you want to assess whether or not owners have done well, you have to look at this bigger picture. And my position is very urgently and strongly is that owners have generally benefited from the entire regulatory environment. If you were to strip away the public inputs and the unique pressures brought to bear on New York's housing market, the value of housing would fall. Now, it wouldn't fall in an individualized context. For example, if you lifted zoning restrictions on a brownstone, but if you lifted all of those public inputs, ultimately we would live in basically an unlivable city, and the value housing would be far more plentiful, but probably be far less safe. The city would be a terrible place to live, and the ultimate return on real estate values would be far less than it is today. So if you want to look at this fairly, you have to, assume that the regulatory environment is a product of a very complex series of democratic compromises over time in order to achieve, a number of goals, including quality of life, including affordability, including sustainability and return on investment. And you're a part of that process. And I think that the board, on balance, has overcompensated owners and is certainly in a position where it can hold back rents in this year, and also reflecting the fact that we're still in this anomalous pandemic period and the market really hasn't settled. So I don't think any sharp departures from the past should be considered based upon just an annualized portrait of what you're looking at. And I'll be happy to take any questions.
Thanks, Tim. I just want to make sure that everyone, there was some confusion about our links. So for the staff, just thank you, Brian, for changing everyone to tenant. So the only people who are testifying are the folks that we receive names for. So if you are on the call and you are just listening in or supporting the folks testifying, that's great. You're going to remain on mute. And you will not have an opportunity to speak other than the person who signed up ahead of time. I'll say that in Spanish just because I recognize the demographic we're working with. Muchas gracias a todos por venir esta tarde. Solamente estoy haciendo un anuncio para dejarles saber que solamente las personas que nos dieron su nombre y ya teníamos planes de oír su testimonio van a poder testificar esta noche, mientras las otras personas que están aquí para apoyar a las personas que van a testificar, está bien, no se preocupen, se pueden quedar en la línea, pero lo vamos a mantener en mudo el tiempo que estamos oyendo los testimonios. So thank you all. I think we're going to move over to Oksana unless there are any questions on Tim's testimony.
Yeah, Shayla, let's do some questions. I'm sure people will have questions. I'll start with mine. So Tim, I'm going to kind of ask the inverse of what I asked Vito this morning when he was kind of saying, oh, the situation is dire. But I look at your chart and I see that whether you look at audited cost to income ratio or net operating income ratio, which are just inverse numbers of each other, that the board, that those ratios have been within a pretty narrow band since 1991. So NOI ratio has been between 0.35 and 0.45, I think, and we're squarely in the middle at 0.40. So how do you read that? I mean, so I know that your last two columns indicate that there's this gap between what's necessary and what we've actually done. But in another sense, we've been operating kind of within this band over time, and we're squarely in the middle of that band right now. I'm curious as to your reaction to that.
Well, I think that the actual number that you have for the current O&M to rent ratio, the 60.2, is a product of a variety of things, including legislative changes, deregulation for a long period, MCIs, and so on. So those things were in effect. I think that my point is that had the only thing that would have affected owners over the last 30 years been the actions of the Rent Guidelines Board, they would still be better off. Where they would be exactly in terms of the O&M to rent ratio, I can't say, but they would still be better off. And my other point again is that with the aging of the housing stock, that O&M to rent ratio should go up a little bit. And I should also add that, this range of net operating income from 35 to 45% may seem like kind of a narrow band, but it's actually a huge band in terms of its impact on tenants. If you think about it, if the average tenant is paying $1,000 a month and the rents are increased by 5%, that's a lot, and that's what would affect that ratio over time. So I think that the numbers are consistent. I think that there are distinctions to be drawn. I think that the RGB staff's finding of a 46.6% increase in NOI after adjusting for inflation over the last 30 years is generally accurate. And I think that much of that can be attributed to the actions of the board, though not all of it. And again, I emphasize that my numbers are very conservative because if I were to measure NOI, which I can't do, but if I could measure it based solely on the decisions of the Rent Guidelines Board, NOI would not have risen 46.6% after adjusting for inflation, just based upon what the Rent Guidelines Board did. Clearly, there were other factors, but NOI would have risen, and that's the problem. NOI would have risen at a time when tenants were really up against the wall in terms of rent burdens and in terms of evictions, and that's why I get a little fired up about this, because I see it in my practice, and I know the attorneys who work for legal aid and legal services and now working for the right to counsel, providing services in that context, see it on a regular basis. We had a brief respite of sorts with ERAP and the moratorium, but ultimately that money is going to end up, with the landlords, as it always does. I'm reminded of, people are talking about, well, the state should be funding all these tenants, and we should get rid of rent regulation and just let the state pay for people who are having a hard time paying high rents. And I'm reminded of a study that was done of Walmart employees back in 2013, where it was discovered that Walmart employees then receiving fairly low wages ended up having to get about $6 billion in various forms of public subsidies, whether Medicaid or housing vouchers or food stamps, which in effect was a massive subsidy to the Walton family, one of the richest family on the planet. And so, look, I think we should have subsidies for tenants, but to pay reasonable rents that are fair, not subsidies in lieu of reasonable rents. And I think, again, if you take a measure of how owners have done, whether in terms of NOI or in terms of actual sales prices, which we have some blind spots in, I think that it's clear that they've done very well.
Thank you. Arpit?
Yeah, thanks very much for your comments, Tim. I just want to understand the table that you produced here. So if I have this correct, are you saying that for 2021, the measure that would leave the kind of cost and NOI growing on trend is that 7.759% number? So that would be kind of an appropriate number in your view if things were already on balance, and it's this legacy issue that's kind of the key problem with applying that number?
You're talking about, I just want to know which number you're referring to, the 7.759.
The 3.759. So that's the cost times the O&M ratio, and added to the NOI times CPI. So that's the number, I take it, that's growing NOI at CPI and multiplying the cost by that O&M ratio. So is that, I just want to understand, is your view that that number is appropriate for growing housing costs if things were on trend?
If all other things were equal, and the only thing that you were looking at is the combination of operating cost increases and inflation, then I think that you would be certainly in a stronger position to seek higher guidelines. The problem that I have, a very serious problem, is that in this sort of anomalous market, it's very dangerous to look, it's frankly myopic to look at the numbers based upon an annualized change. I think you have to look at the overall trend and where we are. And that if you look at that in a balanced way, the guidelines would be much lower.
Christina S.
Hi, Tim. It's been a bit. Good to see you.
Hi, Christina.
Thanks for coming. And I was confused. I thought you were a tenant's attorney, but apparently you're an economist. So you wear two hats, and I'm impressed.
I'm actually in my real life, I'm a history teacher, but
Okay, good.
I did sleep at a Holiday Inn last night, so.
Okay. So outside core Manhattan, the median rent is $1,184 a month. And some of the data that we received this morning established that the median rent, stabilized rent, is affordable to 40% AMI earners. So that, in addition to landlords and private owners being responsible for homelessness since 2006, I think, kind of establishes an imbalance in what you testified to.
I never said that owners were responsible for homelessness. Listen, I think that the regulatory regime that owners operate in has to be responsive to the consequences of how rents change and, the availability and affordability of housing. I wouldn't expect owners to do anything less than charge what the market will bear. Now, I think that occasionally there are quite extraordinary individuals who will hold rents back for tenants who are having a hard time, for tenants who are, long-term, solid tenants, that sort of thing. And I certainly commend that. I know from my experience growing up in a relatively small town, my parents had friends who were landlords, and occasionally they would just skip rent at Christmas time and say, you'll catch up, we'll see you in January. No rent needed to be paid in December. That's wonderful, but that's not going to happen in this kind of a market where most buildings are run by professional managing agents, and their metric of success is the return that they produce. And I'm not criticizing that, but the socioeconomic consequences of that in terms of homelessness, in terms of rent burdens, is something that regulatory authorities have to take responsibility for. The state legislature, city council, and the Rent Guidelines Board.
But at $1,184 a month, the median rent outside core Manhattan, I mean, how much lower?
So let's use that rent in a context of the Bronx, where in Community Board 4 alone, people are making $27,000 a year. Let's look into it a little bit more, where that's the medium rent, like the medium income, because I feel like we can talk about the income as a whole, but we can't get granular if we're not getting granular in the income as well, right? So you can't take out, Manhattan as like expensive apartments and say, well, the income is the same. We're going to use the same income in Manhattan and we're going to put it anywhere else in the city. That's not how we look at the data. And I feel like that's like the discrepancy with that comment of $46,000 a year, where I work in the Bronx, people are making $27,000 a year.
And I think that Oksana will be addressing those issues. I'm giving my usual report, basically NOI focused, but there is I think a much bigger picture to consider, and I only touched upon it briefly, but Oksana certainly has a better handle on those numbers than I do.
Thanks, Tim.
I'm sorry, Christina. Tim, I have a few more questions, but I want to start with one on the chart. And this has really been an issue that's kind of come clearer for me over the last few years that I've served on the board. Your chart is looking at buildings with at least one rent regulated unit, correct?
My chart is looking at whatever, I mean, it's a combination of things. It's the critical columns are, for the most part, until you get to the very end where we have to plug in some PIOC data and stuff. But for the most part, it's looking at the buildings that are examined in the income and expense, review. And then the last column is really an abstraction. It's not looking at any buildings at all. It's looking at what the RGB does.
Right. Okay, so excluding the last two columns, I'm just trying to understand. I'm just trying to think out loud whether if we ran this analysis, excluding the last two columns, on buildings that were 80, 90, 100% rent regulated versus the whole universe of ones that are rent regulated, would it change? Would it come out looking differently? So in other words, is the inclusion, and this is kind of coming back to the conversation we're having this morning with the owner reps.
I think it's a great question. Basically, what I'm saying is that if you were looking at a building that was 100% rent stabilized throughout, you would still see overcompensation because they would not have benefited as much from, or certainly they wouldn't have benefited from deregulation during the deregulation period. And they probably would not have seen as much by way of MCIs or individual apartment improvements, although they may have seen some. But what I'm saying is that let's kind of look at an abstract example. A building 100% rent stabilized, no MCIs, no deregulation, no individual apartment improvements. Their net operating income based upon what increases they received from the Rent Guidelines Board based upon normal vacancies and regular renewals would still be better than it was in 2008, significantly better than it was in 2008.
Thank you. Tim, you as the owner reps this morning did kind of have said that the staff should be looking at some additional sources of information. And I just want to kind of talk about them and then ask if you could push us in the right direction. You know, what is the staff not doing that it could be doing? So you talk about three variables: the relative aging of the housing stock and the effect this has on operating cost to rent ratios. And so first question, where can we find better information about that? Second question, actual operating cost to rent ratios from income and expense data based upon updated audits of tax filings to more precisely identified areas of misreporting. Where do we go for that? And then finally, the general profitability of stabilized buildings as an investment as determined by relative changes in sale prices over time, including comparisons with rising values of multifamily property in unregulated urban housing markets. Where can we find that?
Okay. In terms of updating the audits, I think you just go to the Department of Finance. They're the ones who first did it. And I think they ended up looking at, I don't know, 50 or 40, it might have been 46 buildings. It was a small sample and a lot of owners refused to participate. The better way to approach it, and I think this is a highly significant thing, would be to go to DHCR, which has subpoena power, and ask them to subpoena the books of, a sample of owners to determine whether or not what is reported on the taxes, is affected by what is not uncommon, which is an overstatement of cost or a placement of capital items in the cost column. So, the DHCR could produce that information. That's kind of a heavy-handed way to do it. And you hate to have somebody throw out a bunch of subpoenas and haul owners in to look at their finances. But I think the glaring omission here, and if this was a court of law, we would have a missing witness charge. Owners know how well they're doing. They have the books. Owners' organizations know how well they're doing. They don't open the books. They know what kind of returns they're making in terms of sales prices. They will not examine or disclose that necessarily, although you can get at that. So to answer the first question, the Department of Finance, I think, would be the first stop to do an audit. And fortunately, they were cooperative with the RGB back in, I think it was 1990 or 91. And I don't see why they wouldn't do that again. And, we may well find that the reporting to the Department of Finance is more accurate now, and that the audit adjustment factor is too big. And that in fact owners, through whatever changes in the forms are reporting more accurately, and that's fine. The public needs to have reliable data, and I think this data is too old and the sample size was too small to be reliable. With respect to the aging of the housing stock, I think an examination of the upcoming housing and vacancy survey, I think that there is some raw data on the age of buildings that could be compared. And if we find, for example, that the average building in 2021 was 20 years older than the average building that was under stabilization in 1990, then that is going to be significant in terms of whether or not, we are objectively viewing what an appropriate O&M to rent ratio should be. Again, that ratio should be climbing slowly as the stock ages in general. Now, if there's a lot of housing construction going on, it could well be that the age of the stock has gone down, in which case the reverse would be true, that the O&M to rent ratio should be declining and that net operating income should be increasing because newer buildings have higher relative NOI. Now, with respect to sales price data, I think you will hear some testimony in a little bit about some reviews that were done in the New York market. But I do think that the staff has the ability, and maybe in conjunction with the Furman Institute or whatever, to look at, isolate rent stabilized buildings in New York, look at how they have appreciated in value during the period of rent regulation. And by rent regulation, I'd go back to 1943. And examine how that trend compares to appreciated values nationwide, how it compares to returns in the stock market, how it compares to changes in the consumer price index, and ask the question, are owners of rent stabilized buildings as well off as owners of unregulated buildings in unregulated markets which have normal vacancy rates? And I think that would answer the question as to whether or not rent regulation as it's been administered in New York has had a deleterious effect on building returns. And I'm fairly confident that the answer is going to be owners are doing very, very well. And as you will hear in a moment, I'm sure tenants are not doing well. They have not been doing well. And that's why it's so critical that the board not allow any increase that is beyond what is really necessary, to keep buildings stable. And frankly, you don't have to hew closely to ensuring that owner returns are always protected against the effects of the consumer price index. But over the long term, I think that the system has to have integrity. I'm one of the few people, I may be the only person who testifies every year who actually believes in the system. I think it's done a fairly good job. Rough edges, absolutely. Mistakes, some horrible mistakes. But the consequences of not having an intelligent body between a very brutal market and the human beings that are affected by that market would have been disastrous. Rent stabilization has been a great success in New York. Could be better, and you can make it better with the right decisions.
Thank you, Tim. Any more questions from members for Tim? All right. Thanks, Tim. Thanks so much.
I think we're changing the order up,
Yeah.
David.
Oh, yeah, go ahead, Shayla.
Go to Jacob.
Got it.
Next.
All right. So welcome to Jacob Udell from the University Neighborhood Housing Program. We look forward to your testimony.
Great. Thanks so much. Thanks for the opportunity to share with the board today. My name is Jacob Udell, and I'm the Director of Research and Data at University Neighborhood Housing Program in the Bronx, where I focus on trends in multifamily finance that affect tenants and building conditions. You'll be hearing, from tenants in a bit about the real and devastating effects of potential rent increases 2 years into the pandemic. They'll be sharing about that better than I can express it. So I'm here instead to make a few kind of technical points about the real estate market and landlord profit, which I believe should be taken into consideration by the board. I'm going to argue that a full understanding of the operations of rent stabilized housing does not support the notion of a large rent increase, particularly at a time when so many tenants can ill afford one. So the points I want to make are as follows. Number one, a full measurement of landlord profit over the long term should not only look at net operating income, but also at the change in property or asset values. This data, which UNHP has tracked for over 2 decades, shows that multifamily real estate has led to outsized profits for landlords far above the long-term increase in NOI. This fact should impact the board's assessment of the economic viability of the rent stabilized stock. Point number 2, while rising asset values can be captured by landlords in the form of a building sale, it is in fact just as common to use debt refinancing for this purpose. This mechanism, known as the cash out refinance or pulling out equity, constitutes the majority of new debt on existing multifamily properties. Point number 3, all indications are that this type of debt refinancing leads to worse outcomes for tenants and buildings, both in terms of displacement and physical conditions. In other words, far from being used to reinvest, most mortgages are used to profit and pull dollars away from the property. Point number 4, the intention of maintaining net income at its current level through rent increases is to ensure that landlords have enough cash after costs for both operating profit and to reinvest in their building. This approach, however, assumes that debt service is used to access capital for reinvestment, when in reality, it's more commonly used to stay leveraged and profit from rising values. If the role of debt in landlord operations were viewed more accurately, it would be far more difficult for landlords to argue in good faith that large rent increases are necessary to maintain a decent profit and sufficient proceeds for reinvestment. And point number 5, the drop in net income in 2020, which seems to have been a temporary one and geographically concentrated in core Manhattan, is not reason to support a large rent increase. First, there have been a number of interventions that have helped keep landlords whole after a temporary drop in net income, including rent relief, mortgage relief, and the increase of interest-only mortgages. Additionally, this drop in net income does not put buildings at risk of lower maintenance standards, given the long-term rise in net operating income and profits from rising values. Okay, so now I'll get into those a little bit more in detail. So according to the Rent Guidelines Board's own analysis, inflation-adjusted NOI has risen 46.6% over the last 3 decades. While this figure is significant, it actually underplays the rise in overall profitability of New York City rental housing. A more accurate picture includes the rising asset value of rental housing citywide. This is because while landlords can pocket monthly cash flow, the largest financial gains from rental housing come from a higher sales price or debt level. So data from property records show that the last 3 decades have seen rapid and essentially unabated property value growth, which drove the waves of frenzied investor interest in the rental market. One indicator of price appreciation maintained by NYU's Furman Center shows that between 2000 and 2018, multifamily property values rose between 400% and 600%, depending on the borough. UNHP's own long-term tracking of Bronx rent-stabilized properties shows that the average sales price per unit in the borough rose from about $10,500 in 1996 to approximately $175,000 in 2020. And in just the years between 2012 and 2018, multifamily values increased between 100 and 140% in the Bronx, Brooklyn, Queens, and Upper Manhattan. Appendix 1 of my written testimony includes charts that illustrate these trends. If the goal of the board is to assess the economic viability of the rent-stabilized stock to make judgments on rent increases, rising property values must be considered, as capturing these values is central to the business of owning and operating New York City rental housing. Evidence of property value appreciation in the New York City rent-stabilized market suggests that owning rent-stabilized housing is an extremely profitable affair, and ignoring asset values as a measure of owner return therefore distorts the picture of economic viability. Importantly, this is not only true for, quote, corporate landlords, but for, quote, mom and pop landlords too. Asset value appreciation is agnostic to ownership structure or portfolio size, and owning income-producing property in New York City means significant financial gains from the property value trends of the last decade alone. Additionally, it is not only short-term holders, those who buy properties and quickly sell at a markup, who capture rising asset values. Long-term holders can do the same by continually refinancing at higher debt levels, keeping their properties leveraged, and pulling equity out of the building as windfall profit or to buy other investments. So I'll talk about that a little bit now. So while selling a property is one way to capture rising values, what data shows is that refinancings of existing mortgages at higher levels are actually just as frequent a method, if not more so. Landlords can re-up their debt at higher amounts as long as a lender agrees that a property has risen in value and net income can support the mortgage at an acceptable coverage ratio. Landlords can then use this added principal as their own equity. These loans are generally structured as 5 to 7 year instruments that are either interest only or amortized over 25 to 30 years, such that little to no principal is paid down. At the end of each 5 to 7 year term, or sooner depending on market conditions, landlords can refinance and increase their debt once more in order to reap the enormous financial benefits of near constant and rapid asset value increases. As someone who has spent many hours looking at mortgage data over the years, I can say with confidence that the vast majority of debt financing on existing multifamily properties is structured in this way. In other words, most debt on multifamily properties is not about accessing loan capital to use for reinvestment, but rather is part of a business strategy to keep buildings leveraged and to profit from the rising asset value. One way to see this is by looking at the median debt per unit across New York City, which has consistently increased for as long as there's been available data. Between 2008 and 2020, the median debt level has risen between 100% and 200% in the Bronx, Brooklyn, Upper Manhattan, and Queens, closely matching the rise in property prices in those geographies. If mortgages were mainly taken out to cover costs of building improvement, one would assume that debt levels would be largely static or cyclical, as capital improvements tend to happen at regular intervals and debt would be paid down in the periods between actually taking out the debt. For additional pieces of evidence that speak to the predominance of the cash out mortgage refinance, see Appendix 2 in my written testimony. So recently we at UNHP, we published a report in collaboration with LISC entitled Gambling with Homes or Investing in Communities that serves as another way to examine the relationship between new mortgage debt and reinvestment. We identified buildings with both speculative sales and speculative debt measured as per unit annual increase in value. We then regressed this subset against a bunch of data of importance to tenants, like evictions and code violations. The results provide a new empirical basis for what many of us have known for a long time, that speculative real estate practices lead to worse outcomes for tenants, both in terms of eviction rates and in terms of housing maintenance quality. Crucially, the report finds a strong relationship between speculative debt and worsening maintenance conditions. In particular, we found that buildings that took on the greatest amount of additional debt had up to 2.7 times more maintenance violations per unit than those that did not. This finding, that taking on debt is actually a leading indicator of poorer maintenance quality, undercuts the argument that increased investment in loans to multifamily buildings tend to benefit tenants. Instead, it reinforces the notion that additional debt taken on by landlords is more commonly used to extract profit rather than reinvest in properties. It is so important to focus on the way that mortgages figure into landlord operations, because being able to cover the debt service is one of the major reasons offered for preserving NOI by raising rents. But this reason implies that debt is a necessary aspect of preserving maintenance conditions, as opposed to a business decision to use operating profit or monthly cash flow to generate higher returns by capturing the rising asset value. While there are landlords who use debt capital to pay for rehabilitation they could not otherwise afford, including, it's worth noting, many nonprofit CDCs who maintain higher expense to income ratios and keep their units more deeply affordable, all indications are that this is the exception rather than the rule. More often, higher debt levels translate into higher debt service that pulls rental dollars away from expenses, instead going to support equity's return on investment. No wonder then that our recent report with LISC found a relationship between new debt and higher maintenance violations. When landlords use rental incomes to make large mortgage payments over building expenses, conditions will deteriorate. When the board preserves NOI by raising rents, then it may be overcompensating landlords due to a faulty assumption of the net income needed to safely and adequately operate housing while generating a fair return. Accurately accounting for the role of debt in how landlords generate returns from rental housing can shift the calculus of assessing the economic viability of the rent stabilized stock, and actually raises the bar for justifying rent increases to a level commensurate with how landlords actually generate returns. Finally, I'd like to touch briefly on rental housing operations and changes in net income in 2020. As has been discussed in prior meetings, the drop in net income as a result of the pandemic seems to have been largely driven by trends in core Manhattan, which saw by far the greatest declines in income. These declines could very well have been due to drops in the non-rent stabilized parts of the core Manhattan housing stock, namely commercial tenants who fell behind on rent and market rate units that stood vacant as renters absconded from NYC. This drop was also likely temporary, as reporting indicates that market rate rents in New York City have skyrocketed, meaning that those landlords hit hardest by NOI drops will likely have benefited most from market rent increases in 2021. It would seem short-sighted to base rent increases on a temporary shock that was geographically concentrated where rent stabilized units most likely commingle with market rate units. This is especially so because of the many interventions instituted to make landlords whole. Here I'm referencing not only unprecedented rent relief and mortgage forbearance, but importantly, interest-only modifications and refinancings as well. Since 2020, evidence shows that there's been a steady rise in interest-only mortgage periods, which significantly reduce the debt service burden, allowing for less NOI to be spent on mortgage payments for high debt principals. Finally, while net operating income may have fallen in 2020, there are no indications that this puts building operations inevitably at risk. Landlords have enjoyed a long-term rise in net operating income, mostly driven by rising rents, and NOI remains a quite high 40 cents on every dollar of income. At this level, it is difficult to imagine that a temporary drop in NOI of a few percentage points changes the calculus of reinvestment. In fact, within this range, there simply is not a quote natural rate of net operating income, which would be sufficiently high to impair the maintenance standards of a building. Whether to reinvest funds from NOI into the building is determined by other factors, most prominently the business model landlords use in rent stabilized buildings. The outsized profits that landlords have garnered from asset value increases and the role of debt in capturing those increases should be taken into account when determining how much of a burden of landlord profit falls onto renters. Thank you for taking the time, and I'd be happy to answer any questions.
Thank you, Jacob. I have one question, kind of a big picture question, which is if we agreed, or members of the board agreed with you, how would we kind of operationalize taking into account the role of mortgages? Like how would we, how would we quantify how to take that into account?
Right. Well, I think there's a few ways to think about it. I think that as I said, what I'd like to see is that being able to raise, to simply raise the bar for rent increases that happen on a yearly basis. Again, as far as I see it, it's largely a business decision whether to take on debt or not. As in, however much of NOI goes to debt service, that is a choice to either use your monthly operating cash flow as your profit, or to use that money to pay debt, to pay your debt service, right, to stay leveraged. If we understand that as a business decision and not as a requirement of operating housing, then I think that actually makes it harder to justify why landlords would need rent increases at a time when NOI is already at the level that it's at. Again, if we were living in a world where NOI was much smaller, where margins were much more narrower, that might be a different conversation. But I think as it stands now, what I hope that conversation about what debt service does is it makes it harder to argue in good faith that landlords need rent increases in order to maintain a strong profit and to be able to reinvest in their buildings. So that's I guess how I'd answer that question.
Okay, thank you. Questions for Jacob? Alex.
Hi, thank you. I don't know if you can answer this question, Jacob, but is there any way of sort of disaggregating the data to see like what is the debt service requirement in order to cover the actual original mortgage acquisition costs of a property versus the amount that's attributable to cash out refinancing?
Yeah, that's hard to know, in part because the terms of a mortgage structure, I think make the debt service vary so much. I will say that on lots of buildings that we look at, it's not uncommon to see an acquisition mortgage that has been refinanced and rolled over a number of times, such that the debt principal is 3, 4, 5 times higher than what it originally was. And again, that serves as their equity. So again, how that translates into actual debt service increases is hard to say, but I think you could imagine a world where you sort of apply standard amortization terms and interest rate terms, and you could kind of look at that difference in debt service. I'm not sure you can do it in aggregate in any sort of empirical way.
Jacob, we had asked this morning for the owner reps to think about giving us some pro formas about how they take into account debt service and capital improvements that are not reflected in MCIs. It would be interesting if you were up to it to kind of say, well, here's a kind of conservative use of debt, really just for acquisition and for capital repairs. And here's an example of one of these properties where it looks more like speculative and squeezing every last dollar out. That would be kind of I think, a compelling comparison to make along the lines of what Alex is saying.
Sure. Yeah, I'd be happy to walk through that. I should say that, again, yeah, while as a tenant advocate, we don't usually have access to operating data in the way that landlords and investors, including banks, do. We are sometimes able to access that information. And in 2020, I looked at a set of loans, something like 1,300 loans that were originated and then acquired by Freddie Mac through their small balance loan program, which is a significant originator of loans to rent stabilized housing across New York City. And they were commonly using the cash out refinance mechanism. In that situation, I looked at loans in the Bronx, Brooklyn, and Manhattan. We were seeing debt service amounts at somewhere between 40% to 50% of rental income through that data. So again, that's the debt leverage model. And I think you're right that if you were looking at a business model where you had an acquisition loan that you paid down over time, and the only times you took on added debt was to be able to afford capital improvements you couldn't afford out of cash flow, you would have significantly lower debt service. But I can maybe walk through a few pro formas and send that in a follow-up.
Thank you. Christina D.
Hi, thanks, Jacob. If I'm understanding your presentation, it sounds like landlords who have more debt or who tend to, or are more sort of larger institutional landlords tend to, they're just trying to squeeze every last dollar, as you said, out of the building with all of that. So I'm going to ask a similar question that I asked the owners this morning. We're hearing, or what I heard a lot in the last years that I've been on the board is from landlords who are, say, smaller, that because there, as you mentioned, there's the value of the building, right? So they can just sell the building and they have a lot of value there. What are your thoughts on if there is any impact on if those landlords were to sell these buildings to, like, say, I don't know, the Blackstones of the world, or the larger real estate investors who operate, I think, differently than, say, the smaller real estate owners? Like, do you think there's any impact to the rental market, to the housing stock, to anything, or is it just one owner going to another owner, and that doesn't really impact the housing and how it's how the housing stock is maintained or anything like that?
Mm-hmm. Yeah, no. So I think there are, especially at the margins, there are differences in operations. I think economies of scale of some of the biggest owners and their sophistication can oftentimes, at least anecdotally, it seems like lead to worse treatment of tenants, lead to maximization of profits in a way that maybe you wouldn't see at the other end of the spectrum with the smallest property owners. But I think part of what my testimony is trying to do is actually say that for the vast majority of landlords, be they quote unquote corporate or quote unquote mom and pop, there is essentially one way to function in a market where asset values rise so quickly, right? So you could be a smaller landlord or a multi-generational office and own 50 units or 100 units, and you're still gonna, if you're thinking about how to maximize profit in a given rent stabilized property, you're still going to think about this notion of leverage. You're still going to think about selling your property for a higher value at a different point. So I would say that a big part of what I'm trying to do is actually to say that for the vast majority of owners, there are structural forces at play in terms of how the market moves and where the real dollar signs are that make the distinction between the mom and pop and the corporate landlord maybe a little bit overemphasized, if that makes sense.
Yeah, I do. Yeah, it's hard, right, when we have like one tool to use on a very diverse market. Thank you.
Mm-hmm.
More questions for Jacob? Okay, hearing on Jacob, thanks so much again for your testimony. We appreciate it.
Thank you.
Shayla, are we moving to Oksana?
I'm looking. Alan, what do you think?
I think it'd be best maybe to move to a tenant first, and then maybe we can have Oksana go after.
All right, can Adon or Shayla, would you introduce the tenant who'll be speaking?
So I see Karen on the line, but she's currently on the phone. So you're good? I see her. She's going to go on. Okay.
All right, so I think our
Karen,
next.
I was just going to say, Karen, if you can take a couple of minutes to share a little bit about yourself and your current housing situation, that would be great.
Karen, let me just introduce you verbally. So Karen Small from Tenants and Neighbors, welcome. We look forward to hearing from you. And you're muted still, Karen. Yep, there you go.
I'm unmuted. Oh, I wasn't ready for you to come to me already. Can you go to the next person and come back to me?
Yeah, that's fine, Karen. We'll come back to you soon.
Yeah, I'll be ready in a second. I don't want you to hold on while I pull up my notes.
Sure, that's no worries.
Okay,
Yeah.
great. Thanks.
I think the other two speakers, and folks can correct me, specifically Hal, since your guys are tracking this a little bit better than me. The next two speakers are monolingual Spanish speakers, Hal. So your choice on who goes first.
Yeah, and Hal, just introduce them by full name and if there's an affiliation as well, please. And Hal Bergold from CASA is going to be translating.
Sure. Jeanette, ¿está lista?
Sí, yeah.
Okay.
¿Puedo?
Un momento. So my understanding is that there is Maritza is on the line from Woodside on the Move, who's able to translate for Sandra Dominguez for Woodside on the Move. And I'll be translating for Jeanette Perez from CASA.
Great.
Okay, Jeanette, adelante, si puede tomar pausas algunos momentos para que yo pueda traducir. So just saying if she can make pauses like in her testimony so that I'm able to translate.
Sí, buenas tardes. Mi nombre es Janet Pérez. Le quiero compartir mi testimonio debido a que cómo van a aumentar la renta hoy en día con tantos problemas que hay debido al desempleo, a la pandemia. Yo, por ejemplo, tuve que aplicar a ERA para poder pagar mi renta y ERA no me pagó como tenía que pagarla porque hubo un mistake y todavía estoy esperando que me puedan ayudar y debo renta. La otra problema es que en el building donde yo vivo hay muchos problemas. Yo tuve que llamar a la ciudad porque había un liqueo meses y meses y el landlord viene con molesto a tocar las puertas que por qué se llama la ciudad, pero si no arregla hay que llamar la ciudad. Entonces ahora mismo aquí hay problemas, mira, hay rata, la puerta tú la jalas de la entrada y puede entrar cualquier persona. Los apartamentos liqueo y hay muchos problemas en este building. Entonces, ¿cómo podemos decir van a alzar las rentas si no arreglan y el landlord no coopera? Tenemos muchos problemas, necesitamos esa ayuda de que se apare la renta porque si no vamos a quedar desalojados. Necesitamos la ayuda. Ahora mismo hay muchos problemas aquí. El landlord se le pide que quiera hablar con nosotros y él nos da la cara. Él no quiere dar la cara. Entonces, ¿por qué si podemos llamar a la ciudad para que arreglen y él no arregla? Y él se molesta contra los inquilinos. Porque él se molesta con los inquilinos y no quiere. Nosotros no tenemos un súper que esté 24 horas aquí en un caso de emergencia. Ahora mismo yo debo mi renta porque ERA no me ha puesto, estoy solicitando a Welfare. En cualquier momento, si a él le da represalia contra mí o cualquier otro, me puede sacar. Y eso es lo que la preocupación es, que tenemos que parar la renta, no podemos seguir subiendo la renta porque no hay trabajo y estamos en una pandemia todavía. Necesitamos ayuda de los abogados, de los representantes de aquí, del Bronx o del estado de Nueva York, donde sea, pero necesitamos su ayuda, por favor. Gracias.
Gracias, Janet.
Okay.
So her name is Jenna Perez, and she is asking for help. She's experienced unemployment during the pandemic and applied for ERAP, but not all of it went through, and so she's still waiting to get the full amount paid to her through ERAP. At the same time, she's living in a building with a lot of problems. So she's had a leak in her apartment for months now. When she calls the city, the landlord comes to her door and like harasses her, asks her why she's calling the city. At the same time, they have rats going through the apartment. The front door is open so that anyone can walk in, and she's also aware of leaks in other apartments. She's asking for help from attorneys, from Bronx Electeds, and from here to freeze the rent. Otherwise, she doesn't know how she's going to stay there. Otherwise, she'll be evicted. Again, she repeated the fact that when she expresses these issues to the landlord does nothing. When she calls the city, the landlord goes to her door and asks her why she's calling the city for these issues. There is no 24-hour super in the building, so there's no one to go to if there's any emergencies. And again, that she needs help, and the tenants in her building need help. That's calling on you all to freeze the rent. Thank you.
Thank you, Hal. Gracias, Jeanette.
Jeanette,
Okay.
solamente, I'm just going to ask her a question. Anteriormente, esta mañana oímos de los caseros que estamos hablando de cantidades pequeñas, ¿verdad? Eso fue lo que asumieron ellos, que un incremento de renta de $89 al mes no es mucho dinero para ustedes. ¿Cómo te afectaría eso? Voy a hacer la pregunta en inglés antes que me respondas, si me das un segundo. So I'm basically asking her, earlier this morning, we heard from owners that an $89 increase for tenants is just, it won't be impactful. It's just a small amount. I'm asking her to share a little bit about how that would impact her as a tenant.
Sí, mi corazón. Ok, nos afecta en parte. Si tú no tienes un trabajo fijo, son $89 que se van acumulando mes a mes, mes a mes. Cuando mira a ver, el landlord se va haciendo rico porque va acumulando más dinero y más dinero, ¿entiendes? Pero coopere también con nosotros para poder pagarle mejor. Ayude a arreglar sus apartamentos y estamos un poco mejor, pero no hay trabajo, y si hay que trabajo, está muy flojo, ¿sabes? Eso nos preocupa porque se va acumulando la renta. Entonces, cuando miremos a ver, el landlord va acumulando, sí, ¿qué hace? Lo primero que hace es ir a la corte, tratar de desalojar a uno, nos desalojo porque no tenemos empleo, renta el apartamento por más dinero, y ese es el problema que hay. Entonces, ¿quién nos va a ayudar? Por eso es que te digo que si aumentan $89 va sumando más 89, va subiendo demasiado. Entonces, si tú pagas un poquito tarde, te cobran un recargo adicional que va subiendo 89 más el recargo. Dígame a ver, mensual. Ese es el problema que hay.
Gracias.
Okay, mi amor.
So just to voy a traducir. Just to translate, $89, yeah, for sure. I mean, like it doesn't sound like much, but it's each month $89. She's unable to get steady work. And so on top of that, she's mentioning like, the months that she's not able to make that end meet, there'd be a late fee. And at the same time, the landlord is not doing what they're supposed to. Like that's the main thing, right? And so it would be one thing if those $90 went back into the building, but that's not what she's saying happens. And so what would happen is really that they would take her to court and they would evict her if there was an extra $89 a month.
So we'll take a little bit of a shift and go to Oksana, if you're ready, and then we'll hear from some more tenants later.
Gracias, Janet.
A la orden.
Our next speaker will be Oksana Mironova from the Community Service Support Society, the Community Service Society of New York, CSS. Oksana, welcome. We look forward to your testimony.
Thanks so much, Shayla and David. And thank you so much for the opportunity to talk about RGB's guidelines. My name is Oksana Mironova, and I really enjoyed seeing so many Oksanas on the Zoom screen earlier. That doesn't usually happen, but so that was fun for me. And I'm also joined by my colleague Samuel Stein, who will be here to answer any questions that come up. We're both housing policy researchers from CSS, and CSS is an independent nonprofit organization that addresses some of the most urgent problems facing low-income New Yorkers. Since 2002, we have been administrating our annual Unheard Third survey, which is the longest running scientific survey of low-income communities in the US. And we hope that some of the data that we have about rent stabilized tenants from going back to 2021 will be helpful in your deliberation, just because it's newer than what is available in the HVS. The first key point that we want to stress is that for rent stabilized tenants, the fallout from the pandemic continues. I was kind of shocked to hear the landlord testimony earlier this morning that pointed a fairly rosy picture of what's happening to rent stabilized tenants. That is not what we're seeing in our data, and we'll talk a little bit about that now. We know that while some sectors of New York City's economy are seeing signs of recovery, others are stuck in what a Bloomberg reporter describes as a COVID-induced malaise. New York City's seasonally adjusted unemployment rate is currently twice the national average. Our jobs deficit is 3 times the nation's and is concentrated primarily in low-paying jobs. In the fourth quarter of 2021, the unemployment rate for Black New Yorkers, who make up 22% of rent-stabilized tenants, was 15%. Even before the pandemic, low-income rent-stabilized tenants' incomes did not keep up with rising rents. Among low-income renters in particular, inflation-adjusted rents increased by 26% since 2002. As a result, the median rent-to-income ratio, the share of income a household spends on rent, among low-income stabilized tenants, increased from 40% in 2002 to 52% in 2017. And this is the latest data that we have because this relies on the HVS. By 2017, because of rent loopholes and high RGB rent adjustments that Tim Collins covered in his earlier testimony, the rent burden gap between stabilized and unregulated low-income tenants essentially disappeared. Our 2021 Unheard Third survey provides more recent data than the 2017 HVS. We know that during the pandemic, low-income New Yorkers bore the brunt of economic loss. This was widely covered in the media and is an accepted fact by this point. Among low-income rent-stabilized tenants in particular, 40% lost employment income during the pandemic. Because of high living costs in New York, most low-income people are simply not able to save money for an emergency like a sudden loss of income during a pandemic. We found that 65% of low-income stabilized tenants have less than $1,000 in savings. As low-income stabilized tenants lost work, rents continue to go up for many. 38% experienced a rent increase in 2021, even though there was a 1-year rent freeze, as you all know. These increases, it's hard to say why, but likely these increases account for 2-year lease renewals, illegal rent hikes, and rent increases associated with major capital improvements or MCIs. We also asked our respondents to answer whether or not their buildings have underwent improvements, and we found that 37% of low-income rent-stabilized respondents did experience improvements in their buildings. And that's despite a low rent adjustment in 2021. Landlords continued to invest in buildings despite a 0% increase for buildings, for rent-stabilized buildings. Second, eviction cases mount as pandemic era programs end. The federal and state eviction moratoria and direct relief helped hold back a sharp increase in evictions and homelessness during the height of the pandemic, so in 2020 and the beginning of 2021. But those temporary solutions have mostly expired. The eviction moratorium ended on January 15th. The state awarded about 143,000 emergency rental assistance payments, or ERAP, paying landlords $1.8 billion, but with no assurance that tenants will have the resources to pay even higher rents moving forward. And unfortunately, what Jeanette just described as her experience is systemic. An additional $919 million of federal and state funding is forthcoming for ERAP, but it will cover only half of the outstanding ERAP applications that are still left. There's 183,000, leaving tenants in an extremely vulnerable position. The city, state, and federal governments have failed to replace these temporary programs with permanent solutions. Something like an extension of federal Section 8 vouchers, which was included in the Build Back Better bill on the federal level, but that's stalled and probably not going to happen. Or the state's Housing Access Voucher Program bill, which was excluded from the final state budget. Given the combination of untenable pre-pandemic rent burdens, the loss of employment during the pandemic, especially among low-income rent-stabilized tenants, and the failure of all levels of government to repair a decimated social safety net, which is a bigger problem, but is really felt among low-income rent-stabilized tenants in the city, many low-income rent-stabilized tenants are a step away from eviction. When we fielded our survey in the summer of 2021, 1/3 of low-income rent-stabilized tenants reported being worried that they would be evicted or forced to move when the eviction moratorium expired. And even before the moratorium expired, 13% of low-income rent-stabilized tenants were threatened with evictions illegally. Today, there are 227,000 eviction filings in housing court, including nearly 205,000 of non-payment cases and over 22,000 holdover. A little more than half of those are pre-pandemic evictions, though the share of new evictions is quickly rising every single day. The most recent household pulse survey from the US Census shows that nearly 1 in 4 of all New York households reported being behind on their rent. A portion of these households will face evictions, which will take time to make their way through the courts, and we're likely to see a rolling increase in non-payment cases all through the summer and fall, which is when the current RGB rent increases will go into effect. And our third point that we want to make is that rent regulation is a key for keeping New Yorkers in their homes. The guidelines this board enacts are some of the most important factors that determine the stability and well-being of low-income New Yorkers. To us at CSS, we define low income as people earning below the 200% of the federal poverty line, or $43,000 for a family of 3. According to the 2017 HVS, again, this is the latest data that we have, there's 365,000 low-income households living in rent-stabilized housing, and that's double the number of those living in public and subsidized housing combined. 76% of rent-stabilized tenants identify as Black, Hispanic, or Asian, and nearly half are immigrant households. Rent-stabilized households are also more likely to be headed by women and include senior citizens than tenants in unregulated housing. From the HVS, we know that rent-stabilized tenants make on average 1/3 less in wages and salaries than tenants living in unregulated apartments. The percentage of tenants on public assistance is nearly twice as high in rent-stabilized housing as in non-regulated housing. And while rent stabilization is a means of regulating rents and tenancy rules, and not a means-tested subsidy program, it is one of the most important housing resources available to low-income New Yorkers. Rent regulation mediates the severe power imbalance between tenants and landlords, which is especially true in tight housing markets like New York's. And on the neighborhood level, rent regulation acts as a counterbalance to gentrification and as a bulwark against displacement and homelessness, helping residents stay in their apartments. On the city level, it provides groundwork for other programs like the really effective and currently extremely embattled right to counsel law, and helps promote integration without displacement. While there are programs that help vulnerable rent-stabilized tenants stay there in their homes, like Free and Dree, which I know came up this morning, they're extremely underutilized. According to the DOF, only 43% of the roughly 175,000 households eligible for either Spree or Dree were enrolled in 2017. And again, this is the latest data that we have. The number might be a little bit higher now because the city did a big push to inform eligible households of their eligibility, but it is a difficult population to get to. So that's why the number is so low. We know that the legal service providers representing low-income New Yorkers in housing court are facing astronomical caseloads with up to 80 cases per attorney due to the volume of evictions. And despite New York City's right to counsel law, tenants facing new evictions in most of the boroughs besides Staten Island do not currently have representation. In a 2022 report, Coalition for the Homeless, which is kind of like a top tier nonprofit advocating for homeless New Yorkers, wrote that it is no surprise that the family shelter census dropped for a period concurrent with the eviction moratorium. But since it would be nothing more than wishful thinking to believe that underlying conditions that have fueled family homelessness for decades magically disappeared during the moratorium, we can only assume that the surge of homelessness will occur in the months and years ahead. So this is fairly strong language from a nonprofit. The RGB cannot set federal or state policy on evictions or homelessness. Like you can't do anything about the Build Back Better bill or the fact that HAVP didn't pass, but you can ensure that rent stabilized tenants are not pushed into housing court and then into the shelter system by a thinly justified rent increase. So what we talked about was largely systemic issues facing rent stabilized tenants. And you heard a little bit about actual experiences people have from Jeanette, and you will hear more from the testimonies that follow. And we at CSS strongly encourage the RGB to reject calls for rent increase of any kind. Thank you. And Sam and I are here to answer any questions that you may have.
Thanks, Oksana. Adnan, I'm going to ask a question, and then you'll jump in after me. So one of the challenges that we face is that we see that those who are employed, that their incomes have gone up, and they could handle a rent increase of some kind of rent increase. And then on the other hand, unemployment has also gone up, and those tenants are going to have trouble paying their rent, whether there's a small or a medium or a large increase. They'll just have trouble paying their rent because they're unemployed. How do you think the board should think about that when kind of the population of tenants is falling into like these two buckets, like those who are still employed are doing somewhat better, but then there's also a significant number of people who are doing worse, but doing worse kind of more globally, that they're going to have a broad set of challenges paying their bills?
Yeah, absolutely. So I would say that I think that there's kind of like a broad set of economic indicators, and there are positive signs within the economy that people are doing better, but I don't know if that's necessarily the case for low-income service workers, people working within the healthcare industry, that like healthcare aides and people who are basically doing the service work that we all need, but aren't getting compensated properly. So there's movement in this issue. There's like things like the Amazon union and other cases of wages going up. But I do think that it's not necessarily the case that there's like the employed bucket and the unemployed bucket. I think that there's the unemployed bucket and also everyone else who is making, whose wages have been stagnated for the last 25 years. And I don't know, Sam, if there's anything else you'd like to add to that.
And the only other thing that I'd add is that it's not a perfect binary between the unemployed and struggling and employed and newly rising wages. There's a lot of people who are marginally employed or employed in gig work or employed in fluctuating industries like tourism that are having a really hard time keeping up. They might be making some wages, but those wages aren't enough to sustain a big rent increase this year.
Thank you, Sam. Adnan?
Thanks. So first, Oksana, I want to thank you for really painting a picture and putting a face to some of these more nuanced sort of or data and issues. I too was appalled by some of the categorizations that were being thrown around this morning in terms of who is most affected and how much of an additional rent burden folks can carry. I did have some questions about sort of the unheard third, the findings that you guys have had. What specifically about ERAP and ERAP payments? Because we heard a bit this morning about from the landlords about the amount of applications and the money that have been expended. I also want your thoughts on the accuracy of that data that was kind of thrown around.
Yeah, thanks so much for that question, Adon. So in our 2021 unheard third survey, we did ask tenants about whether or not they received rent relief through ERAP. And we found that among low-income renters, so this is people who roughly fit into the ERAP, the means test, though not exactly, rent-regulated tenants were 10 times more likely to receive ERAP funding than unregulated tenants. And in our sample, low-income regulated tenants had a 42% success rate compared to a 6% success rate for unregulated low-income tenants. So there's, it's kind of like, again, we're asking these questions in the survey. So the reasoning for this is only like an educated guess, but it could be everything from there's just more low-income renters living in stabilized housing than in unregulated housing, and that checks out with HVS data, to the ability of rent-regulated tenants to kind of bargain with their landlords a little bit better than unregulated tenants who just don't get their leases renewed when they try to push their landlords to do something. And so the second part of your question about the accuracy of the data that was presented this morning by the, I think it was the RSA rep. So I'm reading directly from the response of the Office of Temporary Disability Assistance in response to the FOIL that the RSA filed. And the Office of OTDA, which is the office that holds the ERAP data and administers the program, said that while, and I'm quoting verbatim, while OTDA is disclosing this information, there is a significant concern about the reliability because the data was self-reported by ERAP applicants, who in many cases appear to have misunderstood and incorrectly answered the inquiry about rent regulation status. So it's like from a research perspective, fairly unethical to present data and then do analysis to it if the people who are answering the survey are answering questions incorrectly because the questions weren't worded well, or if because they didn't understand what the question was asking. So I would take that analysis with a grain of salt.
Thanks.
Any more questions for Oksana? Christina S.
Hi, Oksana. Thanks so much for your time today. I have a question. You alluded to tenants not having accessibility to SCREE and DREE and assistance in helping with that paperwork. Is that something that CSS does?
Yeah, absolutely. So like I said, the data that percentage that I presented was from 2017, and that was unfortunately the only data that the Department of Finance has made available about SCREE and DREE enrollment. And I wish that there was more data, but CSS is a really big organization, and one of the departments that we have is called Benefits Plus. And what they do is they train case managers and social workers to enroll people to basically manage different types of programs like SCREE and DREE, but also public benefits and public assistance. And when the city did their big push to increase SCREE and DREE enrollment, I think it was like a couple of years ago under de Blasio before the pandemic, we had a huge role in training people, training case managers, training people who work for various types of faith-based organizations, for hospitals to enroll people in SCREE and DREE. And like I said, I hope that that effort worked, but it's not clear if it did or not. And I suspect based on both Sam and I used to work for an organization called Tenants and Neighbors. And I remember we would get calls all the time of tenants like not even necessarily knowing that they lived in rent stabilized housing, much less understanding that they could apply for SCREE and DREE. So yeah, that's our relationship to SCREE and DREE.
And what other programs does CSS run that helps renters?
So from within our department, we do advocacy. So we work with various types of coalitions on the city and state level to help renters and to change laws around renter policy. But we also have an eviction prevention arm that is fairly small, but works with other organizations on providing eviction assistance, basically like one-shot deals and other benefits like that.
Yeah, I'm just looking at the Form 990 for CSS for 2020 with net assets of $253 million. So I realize that's not, you're not making that, Sam's not making that, but it's a shocking number. And
congratulations for having the funding to run all those amazing programs.
The evidence, is still out if $253 million can help or can't. So I'm encouraged by the amount of assets that are out there for tenant programs. And I think if owners and tenants organizations could sort of share in the economic burden that is affordable housing, we'd have an easier time every year at the RGB. So I'm certain that my clients don't look at their tax returns and see 253 million, but again, I'm thrilled. I hope that it ultimately finds its way to some tenants.
I would love to see your clients' tax returns. Unfortunately, we're a nonprofit, so our data is public, your client's data is not, but I feel like Sam is trying to say something, so I'm going to hand it to him.
I mean, so most of that money goes toward getting people covered through healthcare. We have a large public health arm. We get funding from the city, state, and federal government to run programs to enroll people in the Affordable Care Act programs. That's the bulk of that budget. We're also a 175-year-old organization. We have an endowment that helps us run, so we're not as dependent on foundation funding, which can be fickle from year to year. But yeah, I mean, I'm not sure what the implication of that line of questioning was, other than we're trying really hard to help tenants and promote public policy that helps tenants as well.
Yeah, sure. No implication. Just there was a comment about assisting tenants with SCREE, which actually is a super helpful program to senior citizens. And with the budget, I would think that there could be more of an outreach. I just sort of picking up on what Oksana said about helping tenants get on SCREE injury.
Absolutely. And we did do a lot of work helping with the outreach. Do the clients that you work with help tenants sign up for SCREE injury?
Always.
Really?
In fact, my para does as well. If she encounters a senior citizen who's struggling to pay her rent, we absolutely reach out and give them all of the information about the Department of the Aging and how they can apply for SCREE.
And do you have data?
I'm sure I could get that for you.
So we'll move on to the rest of the testimony, since this is where, CSS is just an invited panelist, not the standard or an inquisition on how they do their work and what kind of work they do. So thank you, Oksana and Sam, for entertaining the questions. I wanted to move on to see if Karen is available to share a little bit about her experience as a rent stabilized tenant.
Okay. Oh, good afternoon.
Good afternoon.
Okay. Yes, I'm Karen Small, and I live at 206 East 87th Street. I've been in Yorkville. I've been here for about 24 years, and my building is owned by Zachary Kleinhandler, and it's under Pinnacle City Management. So recently, my neighbors and I, we've started organizing in my building due to the lack of repairs over the years. It's been very inconsistent with having our super is unreachable. The living common areas, the common areas are unsanitary conditions, and our stairwell has cracked and crumbling tiles. And the building is infested by mice and roaches. And I'm on the 3rd floor walk up, and so it's kind of risky walking up with kind of rickety staircase and things. And when the repairs are finally made, the management cuts corners and uses cheap materials that quickly need to be repaired or replaced again. And next door, there's a luxury market rate building, which is owned by the same landlord and under the same management. And to paint a picture of it, my building has 20 units and currently 26 open violations, while the luxury building next door, which is 200 East 87th, they have 175 units and 0 open violations. And next door, they also have an in-house laundry, a community room, and last year I had my bathroom was being gutted out. And so I went to the doorman and I asked, could I go to it's the 6th floor bathroom. They have a community room where they have a bathroom, and they refused to let me use the bathroom, even though my bathroom was gutted out due to a floor that had been sunken in for 2 years. And they told me to go to use the 5th floor bathroom in my building to walk up to the 5th floor, which was a vacant apartment, and the bathroom was filthy. And so I'm asking for the rent rollback because I cannot afford an increase, and I'm tired of paying rent to a landlord that shows clear discrimination and neglect in the way they treat their tenants, because there's a big discrepancy between my building and next door, even though they own it. And so I'm tired of the landlord trying to make money off of my neighbors and myself. The building has been sold several times over the past few years. And okay, wait, I lost my notes. Okay, I'm gonna go back again. And an increase that the landlords are asking for are unjust, while tenants like me continue to live in despicable conditions and struggle to recover from the pandemic. A rent rollback would only be the start of compensating me for the conditions that I've had to live in for the last 24 years. Thank you.
Thank you, Karen.
Okay. Maritza, ¿estás lista? Yeah. Okay. Maritza will be translating for Sandra Dominguez, who will give testimony in Spanish. Sandra, cuando esté lista, puede comenzar a hablar.
Sandra está lista.
Sí, muy
Antes que
buena.
nada, déjenme saludar a todos. Muy buenas tardes. Thank you, everyone. I'm so happy to be here tonight. The reason is not what I wanted to be, because 2 years ago, we were fighting for a pandemic that just affect us all in so many ways. And right now, 2 years later, we are fighting for this second wave of pandemic, fighting for our home, fighting to be safe, fighting not to be evicted, and fighting with scrupulous landlords that wanted to take advantage of this community that is affected in so many ways. And I think that for all of us, it's not right just to be here, keep fighting all the time for stuff that we deserve at the last. Sandra.
¿Quién me va a servir de intérprete?
Sandra, puedes empezar a hablar. Haces las pausas para poder hacerte tu traducción.
Sí, ok. Muy buenas tardes, mi nombre es Sandra Domínguez. Vivo en los edificios de Cosmopolitan Houses en el sector de Bullseye. Vivimos en estos edificios por muchísimos años. Sobrevivimos con el tiempo, con el limitado ingreso de mi esposo,
ya que la pandemia del COVID-19 afectó drásticamente mi hogar, reduciendo el ingreso familiar, limitando nuestra vida cotidiana.
Hi, my name is Sandra Dominguez. I live in Utsan and the Cosmopolitan buildings for many years with my children and husband. My family and I survived with my husband's limited income as the COVID-19 pandemic drastically affected my household, reducing my family income and limiting our daily lives.
Con la pandemia, al igual que muchas familias en New York, debemos decidir si poner pan en nuestra mesa o cumplir las demandas inhumanas de mi insensible casero, que demanda año tras año incrementos que ya no podemos pagar. Durante este tiempo he sido víctima de mi casero, quien se ha negado a cumplir con sus obligaciones, negándose a reparaciones que son mi derecho.
Sandra, wait. Since then, just like thousands of families in New York, we must decide whether to put bread on our table or comply with the inhumane demands of my insensitive landlord, who demands increases year after year that we can no longer afford. During this time, I have been a victim of the abuse of my landlord, who has refused to fulfill his obligations by denying me repairs that are my rights.
Vivimos bajo una infestación de ratas en estos edificios en condiciones no aceptables, aún durante estos tiempos difíciles de pandemia, donde perdimos tanto. La avaricia de mi casero no se detiene, mandando NCIs a todos los edificios.
We live under an infestation of rats and in unacceptable conditions. But even during these difficult times of pandemic, where we lost so much, the greed of my landlord does not stop, taking advantage of the loopholes in the law and a housing system that doesn't work.
Y tomando la ventaja de los huecos en la ley y de un sistema de vivienda que trabaja a favor de los caseros. Eso solamente sigue incrementando mi renta con MCIs, que no solo son responsables de la pérdida de vivienda a bajo costo, sino también de desalojos masivos. Ahora les pregunto, ¿una oleada de desalojos causaría un problema de orden público? A ustedes. Diga, Marisa.
The greed of my landlord that does not stop and taking advantage of the loopholes in the law and a housing system that works in favor of landlords only continues to increase my rent with MCIs that are not only responsible for the loss of thousands of low-cost housing, but also mass evictions. Today, I ask you,
para que paren estos aumentos tan injustos a la población pobre. ¿Hasta cuándo seguiremos siendo atacados por los dueños de edificios? ¿Hasta dónde seguirán ayudando con su avaricia? ¿De qué lado están ustedes? ¿Por qué debemos seguir mendigando por justicia?
Today, I ask you, gentlemen of the world, which side of the story are you on? Because we must continue begging for justice. Why close your eyes to humane pain? Enough is enough.
¿Por qué seguir mendigando por justicia? ¿Por qué cerrar los ojos ante el dolor humano? Ya basta de injusticia, basta de abusos y basta de llorar impotencia mientras los caseros llenan los bolsillos a costa de nuestra hambre y miseria. No queremos incremento mientras dure la pandemia. No queremos vivir en la calle y queremos justicia. No hambre, no incrementos, no desalojos, no más MCI, por favor.
Why close your eyes to humane pain? Enough of injustice, enough of abuse. Stop crying with impotence while the landlord fouls their pockets with the cost of our hunger and misery. We don't want increases while the pandemic lasts. We don't want to live on the street. We want justice, not hunger. No increases, no evictions. Gracias.
Tengo un MCI en mi mano y tengo un aumento de renta y no sé qué voy a hacer para el próximo 3 meses que hay que pagar todo. Gracias.
I have NCIs in my hands. Those are no increases that I don't know how I'm gonna pay it later. Thank you.
Thank you for your testimony.
Thank you.
So we have a few minutes left still, and I don't know, Ivan, if you wanted to, I feel like there were a lot of points made this morning looking at data that was really problematic to me, felt often classist and racist in how we frame the conversation of what we take out and how we talk about income. And I wanted to open up that space if other public members have questions about some of the really skewed data from landlords talking about tenants' plight, when we're hearing directly from tenants and looking at data that I think is pretty empirical in what we're seeing across the city. And so I wanted to create some space for those questions if anyone has them, and to have a conversation with folks who can really look at data that is talking about tenants' flight, but also data that isn't based on the goodness of owners or people who want to do good, because this is not what people are asking for. I think Sandra made the very conscious point of saying they're not asking for handouts. They're not asking for something they don't deserve. We're just asking for fairness and for us to look at data in a way that makes sense and that actually allows everyone in the city to thrive.
Shayla, before we get there, let's not forget that Richard Velasquez is here from Goddard Riverside for SRO tenants. So can we start by hearing from him first? Great, thank you. Richard, do you want to, oh, there's your camera. Okay, so we'll turn it to Richard Velasquez of Goddard Riverside Law Project. Welcome. And then we can, continue the conversation after Richard.
Thank you. Apologize for the lighting in the office. Tried my best. I would just like to take a moment to thank the board for providing the opportunity for legal services providers such as Goddard to speak. My name is Richard Velasquez. I'm an attorney at Goddard Riverside Law Project, a staff attorney. I will be orally presenting written testimony which was provided by my colleague, Joshua Komorowski. Goddard Riverside has been assisting SRO tenants in the Upper West Side of Manhattan for over 30 years. It's an honor to address you concerning the issues presently affecting SRO and Class A residential hotels. The conditions warranting the board's vote last year in favor of a 0% rent increase for SROs remain unchanged. Last year, we testified at this board regarding the lack of resources and housing alternatives for SRO tenants, the profitable uses that owners of SRO buildings make of their properties without renting to permanent tenants, and how we witnessed the COVID-19 pandemic disproportionately affect SRO tenants and how we anticipated it to continue to impact them. These conditions remain unchanged, and in fact, they're worse. Our fears from last year about how we anticipated the pandemic to impact our clients have unfortunately come to fruition. And this is only coupled by the recent inflation crisis and its impacts on people with fixed incomes. I would like to discuss three main areas that are affecting SRO tenants. First, the conditions SRO tenants historically and continue to face, the conditions of SRO building owners, and the impact of the COVID-19 pandemic on SRO tenants. Regarding the conditions of SRO tenants often live in barely habitable units, and these are very minimal living standards. Most SRO tenants live in single rooms, typically use communal bathrooms. They often lack any kitchen facilities. These rooms are physically small, with the legal minimum only being 80 square feet per person. SRO units are often considered housing of last resort. Raising rents in such small places, which only continue to worsen, seems morally wrong, and I will discuss some of the reasons how they continue to worsen momentarily. Economically and statistically, SRO tenants continue to be disproportionately impacted due to them often being low-income individuals, many of whom are on fixed incomes, and often people of color. While many of the statistics do not properly represent the conditions SRO tenants face, some of them are noteworthy. While wages and job availability have increased slightly, they are still well below the 2019 level. While unemployment rates have decreased, it is still at a very high 9%. Public assistance cases have increased. Cash assistance, SNAP, and Medicaid have increased by over 2%, 5%, and 2.5% respectively. The overall DHS shelter stays remains doubled from the numbers found in the 90s. More than 50% of households pay more than 30% of their income towards rent, and more than 28% pay more than 50%. There's also studies to show that households have an estimated increase in monthly expenses of over $400, which could be make or break for our SRO tenants. These economic impacts, which may seem minimal to some, can be the difference between being housed and being homeless for many of our clients. As they're already paying a substantial portion of their income towards rent and often are on fixed incomes, any increase to their rent, coupled with other increased expenses, can make them unable to afford to live or pay for other necessities. Additionally, the conditions of building owners only worsen this. The low vacancy rates in New York City suggest building owners have little trouble renting out other units to permanent tenants. However, SRO owners have found more profitable uses of their properties that allow them to reap higher profits and further depleting the availability of affordable housing stock. Some of the methods they increase their profitability are through contracts with DHS, HRA and or HASA, net leasing to New York City colleges, and renting tourists, often legally and illegally. Notably, the hotel reports indicate that operating costs for hotels with rent stabilized units have gone down. Reports from 2010 by the Manhattan Borough President Office show over 1,300 SRO units were lost in the Upper West Side alone between the late 90s and 2010. While some SRO hotels are lawfully permitted to offer transient rentals, the vast majority never inform their guests that the rooms are subject to rent stabilization or what rights guests may have to become a permanent tenant. Despite strengthened laws prohibiting illegal hotels, many SRO building owners find ways to skirt the law and charge exorbitant rates for units intended to be affordable. Further, in 2021 alone, the Mayor's Office of Special Enforcement issued over 2,700 violations for illegal short-term rental of SRO units. For example, the West Side YMCA, which our office has dealt with for many years, is a residential SRO located at 5 West 63rd Street. It lists daily rates for rooms that correlate to a monthly rate of over $3,200 via their listings on booking.com. And this was as of a few days ago. Whereas the conditions of SRO building owners not only worsen the conditions for SRO tenants, they further incentivize the poor practices that these SRO building owners engage in. Then, the COVID-19 pandemic has also impacted SRO tenants negatively. As SRO tenants have historically been amongst the most disproportionately marginalized communities, it is unsurprising that they have also been one of the most negatively impacted communities by the pandemic, both physically and economically. And economic impacts aside, SRO tenants are uniquely vulnerable to contracting COVID or other associated illnesses due to the very nature and layout of their homes. SRO tenants live in high-density areas, high-density buildings with shared living spaces, and are in one of the most heavily impacted cities in the world. Short-term rentals only exacerbate this issue as the building population is ever-changing, and they are often sharing these communal spaces with strangers. Notably, and coincidentally, while SRO tenants are already extremely vulnerable due to their unique renter status, low incomes, and unprotected employment, they're often amongst the same population of essential workers which have supported us throughout this pandemic. For those who have lost work or risked their lives to help others, the burden of increased rent payments will only amplify the physical, mental, and financial hardship they have faced in the past 2 years. Relatedly, New York City tenants have more limited relief available to them in comparison to building owners and will continue to struggle so long as this remains the status quo. For example, in addition to the various relief programs available to landlords which were referenced earlier, such as LRAP or mortgage forbearances, SRO building owners have the cushion provided them by high rent short-term rentals, while tenants have no such cushion. For example, building owners have seen increased opportunity and incentive for short-term rentals as mandatory quarantine and isolation regulations have increased. Further, we have seen alleged violation of building COVID-19 policies used as means to try and evict tenants, which may in turn lead to more high rent short-term rentals if the tenant is evicted. As if a global pandemic and incentivized harassment of SRO tenants weren't enough, a rent increase this year will only worsen the physical, mental, and economic hardship tenants have faced. Therefore, rent increases for tenants cannot be justified for SRO buildings that are not fully occupied by permanent rent stabilized tenants, or the building's income is dependent primarily on sources other than its rent goals. Rental income from permanent tenants pales in comparison to income from lucrative contracts with city agencies to house the homeless, illegally operated tourist hotels, and student dormitory operations. In instances where these are no such operations, rental income could be increased by simply returning to the market all the warehouse units that currently sit vacant. For these reasons, we did not believe the owners of SRO buildings should be rewarded with the rent increase this year, and we urge you to vote for a 0% rent increase with no provisos.
Thank you, Richard.
Thank you.
Richard, not having Larry Wood here to testify is like waking up in the morning and not having the sunrise. So please give him our regards.
I definitely will. He's up in Albany, and I also just want to take a moment to also appreciate the fact that there's so many tenants here, and we regrettably couldn't get a tenant leader of our own to represent, but we always prefer that. And we understand they're the most heavily impacted.
Thanks, Richard. Questions for Richard? Okay. Thanks again, Richard. Okay, so we do have time. I think we're scheduled till 3:30. So let me open it up for discussion. And I'm just going to say one theme that something that I'm going to talk about with Andrew, offline is a little bit like, on both the owner side and on the tenant side, we had suggestions for other things that the staff could look at. And so I think that's a really important subject. And, I think Shayla raised some subjects she'd like to hear from people. I'd love to hear from people if they want to kind of have any more conversations about, sources of data that we should be looking at as well. So just throwing it open though. And I think this is going to be a discussion of board members and staff. The other possibility is people are exhausted, which I also respect. Alex.
Thank you. Following up on this and Sheila's comment about data and all the discussion about how Manhattan is such an outlier in terms of the decrease in NOI, especially core Manhattan. I'm just wondering if it's possible to recalculate the commensurate data excluding Manhattan or core Manhattan, to get a sense of what the numbers would show if you didn't include the sharp decrease in NOI in Manhattan. So I don't know, Andrew or Brian, if you could weigh in on that.
Yeah, I can weigh in, Alex. So the commensurates do not use the expense increase in the RPIEs. It uses the price index only.
Okay.
The only way that we use commensurate is the percentage toward operating and operating costs, so that rent to cost to income ratio. So we're not using NOI, doesn't factor in, and NOI is derived by the portion of the dollar that's expense. So, but we use it from the price index. The commensurates are calculated by that 4.2% increase in the price index.
Arpit?
Yeah, just following up what you said, David, it seems like one possible thing to ask from the Department of Finance would be information on those 100% rent stabilized units specifically, right? In order to, produce estimates, commensurate costs that apply specifically to that segment of the rental stock, because that seems to be a theme that comes up on both the tenant and owner side, that there's something different going on in that subset of the market.
Yeah, I think starting last year before, we started thinking about that, and the more granular we can get, I think we'd all like to see that information. Shayla, did you want to add anything else, or I don't want to extend the meeting if it's unnecessary. I just want to make sure everyone gets a chance.
Oh, Alan wants to say something.
Okay,
and then
sure,
I
Adan, welcome, please.
Sorry, just a quick note on more data asks, I guess, because we heard a bunch on both sides about, debt service, right? And we essentially got from the landlords, oh yeah, 30% is the debt service number that we're playing with. And we heard on the opposite side from Jacob about whether or not the amount of debt service or the debt that they're taking on is being used to reinvest in the buildings, right? I still think there's a huge gap in the data that we have in terms of that exact thing, right? In terms of violations, in terms of, upkeep in a tangible way. And I understand that DHCR will come and provide some input or some data about MCIs and IAIs and, maybe even reduction of services. But I think there needs to be an additional ask. I don't know if it's OCJ or whomever would have the additional data of pending housing court cases that where landlords are being sued by tenants either with or without attorneys about these repair issues, not only during the pandemic, but before the pandemic. And I think HPD can also give additional insight, probably in terms of violations by building, et cetera, because I think that data would be very interesting. And we can probably make some inferences and make some conclusions about that.
I mean, I think that like some of the stuff that we're having discussions around are really about who can bear a brunt of something when there's nothing broken right this second. Like the data is telling us that NOI is lower. I think we heard from other folks earlier who can speak on this a lot better than I can, like Tim, around what the actual impact of that is and like what it looks like on the ground. And I think Jacob's insight around the mortgage data and what actually happens and how it's used is to me really important, because we are talking about a market that isn't fair, right? Like we're not in Wisconsin. People are not bartering. People are not negotiating. The rent is what it is. People are doubling and tripling up. That's what we're seeing on the ground. And we're seeing folks like the tenants that you met earlier today who are sharing their stories and are really struggling to just make ends meet. And so when we are having a conversation on this board about increases, if any of us on this call are making $44,000 a year and are saying, yeah, throw another extra $100 on anything of my expenses, then that's fine. We can make those choices when we buy iPhones, but you can't make those choices with housing. You can't make that choice with food, and you can't make that choice with essential things like transportation. And folks making $44,000 a year are struggling. And in some communities, that is double the income of the median. And so I think that I just want to make sure that when we're having conversations, and I don't expect owners to have sensitivity towards this, but they sound really tone deaf when they make the comments that they make, because we heard from every tenant today, and you'll continue to hear that when we have testimony for the public. You'll continue to hear from tenants that a $10 difference in their rents means their ability to pay their rent or not. A $10 difference more on anything for them is catastrophic. And if landlords are saying it's only $89, then you don't need the only $89 then, right? Because it's only $89. So I do feel like that argument to me falls on deaf ears, but often when we're having a conversation, we struggle to move away from the small landlords. We struggle to move away from that dichotomy of saying it that way. And I think it's problematic. And as a board, we're not here just to make sure people make profits. That's not our mandate. And I just want to remind ourselves that, we exist because New York City doesn't have a fair market for housing. That's why we exist. And we can't lose sight of that when we're having that conversation, because that is literally why we exist.
Shayla, can I push you on this issue about Jacob's research? So how would we quantify, how does that fit into our analysis? We have to come up with a number. So how does the fact, assuming everything that Jacob said was true, what does that tell us about our decision?
I mean, I think it's, I don't know how to address it, because I do feel like there is loopholes, right? For example, from my insight, it's if we hear from a person like, I'm forgetting her name right now, another panelist that spoke, Karen, who mentioned my building has been flipped multiple times in the last few years, right? Like every owner that has gone into that building has understood what the rent roll is and has made a decision to buy and purchase the building with the current rent roll at the current price. And that is a decision that they're making as a person going in with both feet in. I don't think tenants have the same ability to do that. And I think that that's recognized in like the income discrepancies of who lives in rent stabilized housing compared to market rate. And so we as a board, I think, are supposed to look at it and figure out what is the best situation. And I don't know if the best situation during a pandemic is to increase rents. And I feel like that is, you know, it is a business practice. You know, we talk about speculation. I know not all landlords are speculative, but let's be real. A lot of the landlords that we're working and providing and getting data on are owning hundreds of units, sometimes thousands of units. They're using those units to buy other units without putting back in what they need to. We're not seeing people say, my landlord is making way too many repairs that are unneeded. I don't want my rent to go up because repairs are getting done. That isn't the conversation we're having. And so it feels a little bit like we're having a conversation of, do we continue to increase people's ability to potentially make a profit or have a business model that they feel comfortable with? Tenants don't have that opportunity to move around. They don't have the opportunity to leave to another unit. If a tenant moves from their apartment right now, they're likely going to move into an apartment that's more expensive, regardless of whether they were evicted because they couldn't pay rent. And so that is the current reality that we're engaging in. I think the other piece is, you know, in other places like in the Bronx, $1,500 rent is really high when a family household is making $27,000 a year. So us increasing the rent, the market in that space might not even be able to bear whatever rent increases we give. And I think that the RGB is intended to be, you know, like preferential rents were a thing. They're no longer a thing. We have to see what the impact of that is and look at the data, because on the years where landlords were making windfalls, we never stopped and said, oh, you know, tenants are doing okay. Let's figure out how to balance that. We're just moving forward with the assumption that this is just a commodity that people will make profits from, when it is a business practice, when it is a way of doing business, of making these assessments and also taking these risks. The RGB is not intended to make sure that those risks are good for them. And if their folks are struggling, I feel like there's so many, DHCR has a venue for folks to open up their books. I do feel like, you know, earlier comments around like, you know, whether us as nonprofits have money to support tenants. I think it's the same argument we can make on why landlords should open up their books. Maybe that is what we should do, be fighting for legislation to have open books so that we can make an assessment that feels fair to landlords, but we can't do that on the hunches of people who are literally in this as a business.
Any more comments from the board? Andrew, anything from you?
I don't believe so. I just, you know, obviously our preliminary vote is coming up on May 5th. There's some new members on the.
Will you send out the, what's that called? The sheet that we have to fill out and all that stuff?
Yes. So that's what I was going to get into. So there's two things coming your way or more. One is the proposed language that will be adopted at the preliminary vote. And that's essentially the current order, changing adopts to proposed. So that language is when we are voting for whatever the preliminary guidelines are, we're adopting the language at the same time. It is proposed language. You know, things can change in the final, so that's fine. The final, when we have our final meeting, our final vote, that's when that will be the final language of the order. So it's proposed. So I'll be sending that along, as well as for members, especially new members, there's voting sheets where you can keep track of how other people are voting. In addition, we often send around language on how you can put your proposal to make sure that you cover the 1 and the 2-year lease adjustments. We cover loss, and then we cover hotels, which is a separate vote. So generally speaking, we do lofts and apartments as one vote and hotels as another vote. And we'll send around language on how the best way to put forth your proposal. So that will be coming your way as well. And please, and especially for new members, reach out to me if you want to have a discussion on how this will work. You can, I encourage you to view last year's preliminary vote. It's online to see how that works. And David, I know traditionally we go, we rotate between tenant and owner. I believe that's your intent this year. And in terms of going first, I have to go check the video and see who won first last year. So I'll let people know about that as well. And I think that may be it from me.
So the preliminary vote is our next official gathering.
Correct.
Great.
When
Okay.
do we have to submit proposals that we would want to consider on the 5th?
You don't. That's only for the final, if you remember.
Okay.
Yeah. So just to
We
refresh.
can just surprise everyone
Right.
with our proposals.
Right.
there.
So the preliminary is just simply sort of a free for all. I don't know. I want to put it that way, but you can propose anything and it's fine. And it's 5 yeses. Whoever gets the first 5 yeses, that's the preliminary, right? So traditionally, like I said, we alternate between tenant and owners, at least getting a chance to put forth the members on the board, putting forth a proposal that's considered for the preliminary. And then after that, it's at the discretion of the chair of how he wants to take other proposals. So it's been almost for the last, I would have to go back and check for sure, but I sent around the historical tables of what the preliminary guidelines were and where we ended up. In probably the last 15 years or more, it's been ranges for the most part, except for, I believe, 1 year. So that's certainly, and the idea behind the range is that we are not done. We're not done hearing testimony from at the public hearings. There's additional research that we're going to be presenting to the board, different research requests. So the idea is the range is to understand, well, this is where we're looking, but we're still working. So that's where the philosophy behind the range is.
Okay, thanks, Andrew. Any new business from members?
Do we have dates yet for the public hearings like in June, or are we still working on, is that still being worked on? Or did I just totally miss it?
So no, we're looking at the public hearings between, please keep June 13th through June 16th open for public hearings. Right now, we're looking on having a public hearing in the Bronx. And we're looking at having another public hearing beyond that as well. So we'll keep you informed on the different public, different locations, and I'll do that. I'll let board members know where we're at. We're trying to accommodate. There's a lot of different things we're considering, entrance and how the different venues handle it and whatnot, but we very much want to live stream everything that we're doing so people can participate, certainly by viewing the MUI meeting live. And so we're doing everything to make that happen. And I'm fairly certain that that's definitely that will be the case. So we have to find venues that can do that, but we will keep you all posted.
Adon.
Okay, so sorry to go back to like the data and research sort of component of this, Andrew. But I guess I'm still trying to understand as a new board member, sort of how we're approaching some of these issues. And something I was thinking about was in terms of like the commensurate rent adjustments, like the data and analysis you provided, which was determining what rent adjustment would be necessary to keep the landlords income steady, right, from the previous year. What is there a mechanism to do that, to see if the rent stabilized tenant, what would be the commensurate rent adjustment for a rent stabilized tenant from the previous year? Like taking into account like rent burden or other factors to see, it's like sort of a reframing of that kind of data.
Yeah, no, I understand what you're saying. We've never done something like, we've always, the income data specific to stabilized apartments are in the housing vacancy survey, and that's done every 3 years. Now it's been 4 years because of delays with the pandemic. We're hoping to get HVS data. So we could take, and whether or not every 10 years they do the HVS data, it's a new set of folks that they survey every 3 years. So not always comparisons can be made from when you turn the page on that group. So we have to wait to see whether comparing data from 2021 to 2017 is advisable or not. But anyway, long-winded way of getting there is we can take a look at where the tenant's income was in 2017 for stabilized units and where it is now, and take a look at that. It's not a commensurate, but it will be a percentage increase of what's, or decrease depending on what's happening over that period of time. But we don't have a formula on the other side that we put in to try to get to maintaining. I guess what you're asking is how to keep the rent at a level where I guess disposable income for tenants is the same. I guess that's sort of what you're asking. Maybe.
Andrew, isn't percentage of tenants that are rent burdened and severely rent burdened, isn't that kind of, looking at that longitudinally over time, that kind of?
Yeah. The one thing we do have is the rent to income burden. And that's the way we sort of do with the equivalent on the other side. But it's not like it doesn't come out with guidelines, I guess, is what Don is suggesting. It doesn't come out with like, all right, so in order to maintain tenants' economic situation where it is now, we should have increases of 1%. So we don't do it that way, but yes, that similar to the cost to income across the rent ratio we do in buildings, we have a rent to income ratio that where tenants are at, and that's sort of our meter to say that. And with that, with the HVS is the percentage of folks who are paying 50% or more in their as rent and things like that. So that's an invaluable thing that comes in the HVS. And again, maybe a factor with the range that board members are considering here, the fact that we don't have that piece of information yet, which is as new it was, as fresh as it will be, or can be for that specific group of stabilized renters.
If I could just interject, we wouldn't on a yearly basis anyway, the same way that we have the PIOC data on a yearly basis, that we have the I&E data on a yearly basis. At best, we have that data every 3 years. So it would be hard to do it on an annual basis because you wouldn't know how to adjust it in the years in between.
I mean, I guess I'm not saying we should do this, but I guess in theory, you could do it on a triennial basis and just see a trend line. I mean, that would be something you could do if it's valuable.
Yeah, I mean, Danielle could speak a little bit more to that, but I think we've done similar look. We've taken a look at, income and I guess the real versus nominal, costs rise from tenant incomes based on the HVS. I believe we've done that analysis in the past. Again, it's that, we're switching a calendar to a new survey, 10-year period of the survey. So I'm not sure whether we're going to be able to look back to the 2017 to compare it. Is that correct, Danielle? Am I saying that?
Yeah, I think you're presenting it correctly. We just haven't seen the data yet, so we're not sure what we're going to get, exactly when we're going to get it, what can be compared, what can't be compared. But, unfortunately, the HVS is the only data source that we can pare down to rent stabilized tenants. We'd like to compare, but we have to see what comes and what's advised.
And it is my intent to ask HPD to come and present the HVS data as well. And I'm hoping they can do that at our May 26th. Hopefully they will already have made their presentation to the city council by then. It's dependent on, you know, the city council renewing rent regulation for the city. This survey has to be done. And there was a bill signed, I think in February, that extended that deadline. I believe it's June 1st. Does that sound right, Shayla? I think is it July 1st or June 1st? I think it's June 1st. So it's their intent.
Sounds right.
I think June 1st is right. So it's the intent to get that data and report the, you know, the vacancy rate to the city council in May. That's their intent.
Alex, I know your hand was up before. No?
I'll pass.
Okay, all right. Any other comments or queries from the board? All right, I will say it's 3:29 and we were supposed to go to 3:30, so that's kind of extraordinary. So I'll slowly ask for a motion to adjourn so that we use our full minute of time.
It's 3:30 now.
No, 3:30. Okay, then let's do the motion to adjourn.
Motion to adjourn.
And is there a motion to adjourn from Rob? And is there a second?
Second.
Thank you, Christina. Always quick to the trigger. Thank you all. This is I think a really great set of conversations we had, and I'll talk